In today's episode, I'm going to teach you how to use Heiken Ashi candlestick charts to improve your hold time so you stop selling your winners too soon. The original inventor of candlestick charts was a Japanese rice futures trader back in the 1700s, and he actually created two different types of charts. One are the traditional candlestick charts that you and I are very familiar with, and the second is the Heiken Ashi candlestick chart. A Heiken Ashi chart stands for average bar chart. So it's an average, smooth chart, and it makes the price action look a lot cleaner, which for us as active traders, it makes it easier to visualize the trend and to clearly see when the trend is changing. So when you compare these two charts side by side, traditional candlestick charts will give you an edge on your entries, but Heiken Ashi charts will help you hold your positions longer. Let's go ahead and jump into today's class. We're gonna get on the slide deck here. I've got a full screen. Actually, before I do that, let me give you a little teaser of what these charts look like. So this is a Heiken Ashi candlestick chart right down here. And this is the same stock right up above with a traditional candlestick chart. Now, for reference, it doesn't matter whether you're trading stocks, Forex, futures, cryptocurrency, you can use these candlestick charts on any financial instrument, and they are very well respected across small caps, large caps, again, doesn't matter. So this was a trade that I actually took just yesterday, and this is the Heiken Ashi candlestick chart here, where you can see that you have these long stretches of green candles, longer stretches of red candles. And the idea here is that, and I'll show you the calculation of how these candles are created, but it's averaging the price over two candles. So it's smoothing out that price action. And these give a much clearer depiction of trend. So when we look at this over long periods of time, we can see very easily when we're trending one way or when the trend is potentially about to shift. So one of the strategies that a lot of traders will use with these candlestick charts is that once they get in a position, they'll hold until there's a change in the color of the candle. So essentially, it's a much longer hold time, which is what we're going for if we want to really improve our trading. So this is a trade where the stock squeezed up here from $4.60 all the way to $6.25, which is a great move. But here's the problem. You have a great move like that, and let's just say, for instance, that you missed your entry, or all of a sudden you sit down and this stock is hitting your scanner. Ding, 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 ding. It's hitting the scanner, it's moving higher, and you're like, shoot, where do I get in? So with a Heiken Ashi candlestick chart, it's more difficult to time your entries because you're buying in the middle of this long stretch of trend, right? Now, you can see that there's a little dip right here, but it's not, to me, as visually noticeable as that dip is right there on a traditional candlestick chart. So this is the way I like to use these. We've got in the background here my stock scanners and my trading platform, which are just standard candlestick charts. So when a stock hits my scanner, like MLGO did yesterday, it hits my scan, I see it squeezing up, and I'm looking at traditional candlestick charts. We get this first pullback right here, and that's where I'm taking my entry. This is what I call a micro pullback. This is actually one of my favorite patterns that I trade, and this is a pattern specific to traditional candlestick charts. So to give you kind of the anatomy of this pattern, typically it's characterized by a large green candle, at least one, but it could be three, it could be four, it doesn't really matter, but you've got at least some serious rate of change. This is typically triggered, as was the case with a lot of stocks, with a news catalyst. So you've got breaking news that comes out, and that sends the stock higher. So as the stock is moving higher, what's happening? It's hitting a new high, and for me, it's meeting the criteria to hit my scanners. So my scanners are searching for very specific things in the market. We're looking for rate of change, we're looking for volatility, we're looking for liquidity, and so this stock, let's just say it's meeting all of those criteria. So I'm getting the audio alert. So I'll draw a little picture of a bell here. So we're getting the audio alert, ding, 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 ding. All right, so now I'm looking at the stock, but where do I get in? Now, if I'm looking at a Heiken Ashi candlestick chart, I'm just going to see these big green bars. So this is going to be hard for me to really visualize that where should I buy? And so this is where I'm using traditional candlestick charts. And what I'm looking for is that first pullback right here. The first pullback after initial move, for me, is one of my absolute favorite patterns. I call this I often call it a micro pullback. I'll actually put a link in the description and I'll pin it to the comments, top of the comments, where you can download my micro pullback strategy PDF. All right, it's a PDF you can print out and you can start practicing this on your own if you'd like. So then where I'm buying is first candle to make a new high right here. This is the spot where I'm getting really excited. It's that first candle to make a new high versus the high of the previous candle, right? So let's say the high of this previous candle was 375. As soon as this price breaks 375, I'm a buyer. My stop is at the low of the pullback. That's my max loss. And my profit target is a squeeze through the high. But what I know about this pattern is that if I'm getting in at the beginning of a move, typically these will continue to trend higher. Okay, so now let's say I did my micro pullback strategy PDF entry right here. So I'm in at 550, which is exactly where I bought. So I bought this yesterday at 550. Now it starts squeezing up right here, but you'll notice, ooh, we got this little red candle right there. Now, traditionally, most traders who are just using candlestick charts are going to look at this and say, uh-oh, you've got a candle that is communicating indecision and potential reversal. Now, if we get zoomed in on this particular candle, this candle is actually telling us something very interesting. So let's zoom into it here a little bit more. All right, so this candle, do you see how it has this larger topping tail right there? The topping tail is the top of the candle right there. So when we talk about the anatomy of individual candlesticks, what we know is that a candlestick has a body, and it can have a lower wick and an upper wick. We also call these topping tails and bottoming tails, right? So this is the high, this is the low, that's the open, that's the close, if this is a green candle. If it's a red candle, it opens at the top, closes at the bottom, and the candle is red. All right, so candle was going down in price. So what we know is that if we have a large topping tail, so in this case, we'll do it the correct color. So we have a red candle, and it has a large topping tail. And it was after a series of nice, strong green candles, right? So you have a series of nice, strong green candles, and then this red candle here. What this is telling us is that the price, the buyers pushed it higher, and then the sellers pulled it back down. So this communicates that the sellers were in control by the end of that candlestick period, and the candlestick closed red. This is a candle of certainly indecision. In fact, it's a reversal indicator. What confirms the reversal is if the next candle is also red and goes lower. Okay, so now let's look at our charts. So in this case here, we have that red shooting star. We call it a shooting star because it's got that large topping tail. So we've got a red shooting star right here, but the next candle doesn't go lower. And so this would be very, very easy to get stopped out. And to me, as a very active trader, I typically would stop out. I would get out because I see this candle. It's a candle that's indicating a possible reversal, and I jump out of the trade. And next thing you know, it's back up at 6. And then you're like, ah, shoot, do I get back in here? It's at 6:15, 6:25. And now, gosh darn it, look at this move. So let's contrast that with our Heiken Ashi candle. All right, so we'll back this up here. We'll make it center. So the Heiken Ashi candle is not as good with giving us a clear entry. It's not visually showing that micro pullback that I like to see right in this area here. It does sort of, it is there, but it's not as visually clear to me. It's much clearer in this format with one red candle showing a visual pullback. And you can also look at the volume profile more clearly to see, was the volume higher on the red candle? Because if it was, that indicates less selling. If the volume is lower on the red candle, then that's like, oh, okay, this is good. It's just a little bit of pullback, and then we're looking for the next move higher. So you don't get that with this. So this does not excel when it comes to your entries, but when it comes to holding longer, holding until that first candle is red. Now, one of the things to be aware of is the fact that while you're trading, these candles are, of course, actively forming. So it's always possible that a candle could be flashing red, and then closes green. That's tricky because in those moments, I typically would be very close to stopping out. So this is a candle where it was quite firmly red. And to be honest, it's a pretty steep pullback on this candle because we dropped. That was this candle right here is coming through right at this moment, right? So that's that candle. Now, you do have one red candle here on the candlestick chart when this one was green. So that same candle, right? Same time frame. The chart's not perfectly aligned, but same time frame, same moment. The candle is green on the Heiken Ashi, but it's red on the traditional candlestick chart. And that's because this was taking the average of the previous candle to calculate this candle. And this one is just actually taking the current price. So for me, there's a couple of other things I like to use that help prevent false breakouts, help me get out a little bit sooner. So looking at the MACD, for instance, right? We've got our moving average convergence divergence indicator. There's a crossover. We know once we've had the crossover, the price action is going to be choppier. So even though we might see I'll move that like that. So even though we might see a trend on the Heiken Ashi candlestick that begins to move back up, say down here where you've got some green candles, we would still know that, well, wait a second, the MACD is against the trade, so we're not going to take it. So I'm not going to rely exclusively on candlestick or Heiken Ashi. I'm still going to use my technical indicators, but the Heiken Ashi candlestick can help you with your exits. So let's jump into the slide deck here. I'm going to go full screen, and let's start to talk about how these candles are created. So as I said, the Heiken Ashi candlestick was created by the inventor of the traditional candlestick chart. Heiken stands for average, Ashi is bar. These are Japanese candlesticks. So the calculation of Heiken Ashi candlestick charts, the open price, which with a traditional candlestick chart is literally the open price of the candle at that moment, right? We know the anatomy of the bar. So we've got the high, the low, the open, and the close. So this is the opening price of that candle at that period of time. If this is a 1 minute chart, it's a 1 minute. If it's a 5 minute chart, it's a 5 minute, depending on the period of time of that candle. So with a Heiken Ashi candlestick chart, the open is the open of the previous bar plus the close of the previous bar divided by 2. And the close of the current bar is the open plus the close plus the high plus the low of the current bar divided by 4, right? So this is a different calculation. We're still using the same data points of open and close, high and low, but it's using the previous bar in combination with the current bar to smooth the price action. The high is the maximum high value from the high, open, or close of the current period. The low is the minimum value of the low, open, close of the current period. So the high and the low are the same, but the open and the close are different because they're averaging. So the benefits of Heiken Ashi candlestick charts is that they smooth the candlestick, so visually it's easier to stay focused on the bigger trend. And this is especially helpful if you are trading large cap stocks, because what we know about large cap stocks, the S&P might not be a great example of it because the S&P is pretty choppy. But if we look at NVIDIA, we could just pull this up just for a second. And maybe we'll pull up Adobe in a moment because that was one that was trending the other day. So let's see. Where are we in time? So you can see you've got these longer periods where you've got this more established trend. Now it's not perfect, but it's not uncommon with a Heiken Ashi chart to see this is 2, 4, 6, 8, 10, 12, 14, 15 green candles in a row, these long stretches of trending price. And when you're in something that's trending like that, it's a lot easier just to keep holding, right? When you're able to visualize it. With a traditional candlestick chart, it's very common to have, 5, 6 green candles in a row. Oops, Adobe. But eventually, you get a red candle, and then it's easy to get faked out and think, oh, shoot, we've got a red candle. I better jump out of this trade. So we can go back to here at the beginning of the day. All right, so we're going to scroll this back. 1 minute. So I'll zoom out of this one step. There we go. So this is an example here where during this run up, right in this area, you can see that this run up with a candlestick chart was characterized by 1, 2, 3 red candles. Whereas here, once that trend changed at the opening range breakout, you had a nice solid stretch. And it's true that while you had a couple red candles here, the trend was still intact. Yes, you could have said, oh, I should get out because it's a red candle. but the big picture trend was still intact. So I find this to be really helpful for taking kind of like a step back. Now, some people would say, well, what if we just look at the 5-minute chart, right? Just zoom out one time frame for off of the 1 minute and look at the 5-minute. You'll get a little bit of a more smooth price action. And while you're not wrong about that, one of the problems with the 5-minute chart that I have as an active trader is that by the time the candle has formed, it's sort of too late. So you need to have a much looser leash on the stock because of the amount of volatility that can occur in 5 minutes, right? This is a big candle. So even if we actually switch both of them to a 5-minute chart, then you get even more clarity with the Heiken Ashi candle. So let's see. So this one, we'll zoom this forward. So here you get an even longer stretch where it's green. And you get, let's see, so 2, 4, 6, 8, 10, 11 green candles right in the same area. But you can see here that this goes from $512 all the way up to $530. So it's a much longer stretch, whereas this, even on the 5-minute, is still characterized by these red candles, which might cause you to stop out prematurely. Let's see. We can look at, and I'm an active trader, so I like using 1 minute and 5-minute charts, but really I'm using pretty fast time frames. So we'll pull up the S&P 500 just to take a peek at it. So S&P 500 here. So this was the close. So you can see during these periods, of course, it's very choppy, and this definitely helps smooth it out, right? So we're looking at the same. It's the same stock index, but you could see on this side down here, much longer stretches of trending, whereas in this area, it's showing these periodic red candles. And the problem for an active trader is that it's very easy for those red candles to stop you out. So the benefits of the Heiken Ashi candle is that it does smooth the candlestick, so it's easier to stay focused on a bigger trend, which is a good thing. It can help you stay in the trade a little bit longer, even if it's just with a small piece of your original position. Of course, there's nothing wrong with taking profit as the price moves higher, but taking a little off the table, and then holding that last piece until you get that first candle that ends up going red and closing red. But the drawbacks are that because they use the prior period in their calculation, they can lag behind the chart. And so you can have moments where you get that sudden drop. And if you were using a traditional chart, you would have seen kind of the writing on the wall a little bit earlier. Of course, this was a red candle, and so is this and this, but the trend continued. Now, we know that the first pullback and the second pullback are always the strongest. So this is now coming into third pullback territory. And this was a bigger red candle, this one right here. I was kind of surprised when we had it drop down as much as it did, as quickly as it did. But, nonetheless, it happens. I think that if you were using the traditional candlesticks on a micro pullback on your entry, that was a good entry. And then taking a little profit as it squeezes higher is always good. And then final exit once you have a Heiken Ashi candle that is going red. You don't have to wait for it to close red, but once it starts going red and you've got that candle under candle formation, that's what's important to pay close attention to. So candle under candle is the opposite of the first candle making a new high. So when I'm trading this pullback pattern right here, I'm looking for dip, dip. So these candles make new lows, right? This one is right here, and then this one breaks the low of the previous candle. So that right there is a candle going under the low of the previous candle. So it's candle under candle. And then that reverses right here as that green candle makes a new high. This is candle over candle right here. So now we're moving back up. All right, so during a pullback, a good exit indicator can be to hold until you get that candle under candle formation. So sometimes, for instance, like this is a little bit of a funny chart. I just, of course, drew it, but you've got big green candles and then you have this red candle. And then if this next one goes higher like this, you never actually had a candle that made a new low because the red candle didn't break the low of the previous candle. So in this case, the Heiken Ashi chart wouldn't show a red candle, it would only show green, right? And you would have been fine to keep holding. However, if you get a candle that actually breaks the low of the previous candle, like this, that's where we're having a problem. And so you can see that both on the Heiken Ashi and on the traditional candlestick charts. So looking and holding until you get a candle that makes a new low is one of the things that I kind of focus on. An additional drawback of the Heiken Ashi charts are that it is more difficult to find an entry mid-trend. It's in some ways easier for, I think, reversal trading, where you're not getting in until it reverses, either, to the top side coming down or to the bottom going back up. But that's not how I like to trade. I don't prefer reversal trading. I find it easier to trade with the general trend than to try to trade against the trend. So that's where I need the traditional candlestick chart to find my entry as something's beginning to open up. And then I can use the Heiken Ashi chart in conjunction to help me hold a little bit longer on that position. All right, so now the benefits of the traditional candlestick chart are pretty well stated. You can much easier to identify micro pullbacks for the entries. Again, my micro pullback strategy PDF is in the top of the comments and in the description if you want to download it. And candlestick charts are also very well respected for their buy and sell indicators, topping tails and bottoming tails. So many traders are using candlestick charts that when you see a big topping tail like that, a lot of people will bail out because they're like, oh, topping tail means weakness is coming in. So it's good to be able to see what other people are seeing. I would not, under any circumstances, use Heiken Ashi charts instead of traditional candlestick charts. I would only use them in addition to. And to be fully transparent, I typically am only using the traditional candlestick chart. And the reason for that is simply because of my workflow of not having the time on a very fast moving trade to pull up the Heiken Ashi candle, the Heiken Ashi chart. So I have to have a position where I really like the stock a lot and it's trending really nicely in order for me to feel like I have the time to actually come over here and pull this up. Because I only use Thinkorswim. I use it for looking at options, pricing. I'm not really trading with Thinkorswim that actively because it's not the platform that I really like. So this is sort of like on a side chart, but I like to have it as a reference point. And, it's just something that I'm always thinking about because when I look at my statistics and my metrics, which I pay very close attention to, I'm always asking myself, what can I do? What can I do better? And one of the things that I often come back to is that I need to hold my winners a little longer. I'm selling them too soon. I get stopped out, then the price goes higher and I get back in. And it's okay to be kind of like a really active trader and jump out and jump back in. But when you look at some of these, you think, geez, I should have just kept holding. Why did I sell as early as I did, right? Now, this is obviously trending down right here. This area, we were trending up nicely. So that's a little spot right there, which could have given you a nice entry. In any case, I think that it's a nice tool to add to your toolkit. And like any other indicator, it's only going to be helpful if you're using it consistently, but there are going to be times where I think it's going to help you a lot. So yes, the benefits of candlestick charts, there's no question about it. They're very clear signals and they're well respected. And it is easier to identify these micro movements in price. But the drawbacks is that these quick signals is sort of a blessing and a curse because these quick signals can also cause you to exit a position too soon during a moment of hesitation, only to watch it go higher. And this is something that I would say is kind of my biggest struggle, especially during a little bit of a colder market. During a hot market, I don't feel that I need to lean on some of these tools as much, like the technical indicators of MACD, RSI, Bollinger Bands, or Heiken Ashi charts. But during a colder market, I feel like that's when you really need to be like precision trading. You've got to be really dialed in, get your entry, squeeze as much as you can out of that trade, and then don't overstay your welcome. And so if you get in, and then you jump right back out, and then you get in, then you're churning shares, you're getting slippage on your entries and your exits, especially if it's a lighter volume stock or just a lighter volume day in the market. And you would have been better off if you had just taken an initial position and stuck with it a little bit longer. So my recommendation is to test out using Heiken Ashi candlestick charts and do it in the same way that I'm doing it, where it's side by side. So you can, of course, you do this in Thinkorswim and many other platforms as well. So you're looking at it side by side, and you can sort of see as your 1 minute chart is forming, you've got the variation here on the Heiken Ashi chart forming as well. So you can see the two of them side by side. And this is another kind of good example. Light volume at this time, but showing much more trend here, much easier to visualize. So a lot of people really like this smoothing price action when you're trying to hold longer and not get chopped out. Now, like I said, although it's popular with large caps, and people use it with Forex and futures quite a lot too. I focus on small caps. That's the area of the market where I've found the most success. So, if you're trading the same more or less momentum strategy that I'm trading, you could try having them both up side by side. I would continue to use traditional candlestick charts for your entries and then keep that Heiken Ashi chart up for your exits, and try to ask yourself if you can hold until that first candle on the Heiken Ashi chart is going candle under candle red. If you could do that, then I think you're going to squeeze a little bit more out of the position. Now, something that I did to help me fight that urge to sell my entire position when I was up 10 cents was to change the script on my hotkey from selling full position to selling half. That was something that I did because early on, when I first was getting into trading, the way I set up my hotkeys, and I'll drag this keyboard over so you can see it a little bit better. The way I set up my hotkeys were shift 1 was buy 1,000 shares, shift 2 was buy 2,000 shares, control Z was sell the full position at the bid. And so then I said, let's make the control X button sell half. And I'm going to train myself to start pressing this button instead. So instead of selling the full position, I'm going to sell half the position. So by doing that, I get to sort of have that sense of, all right, I've locked up a little bit of profit, I've done right, but I'm still keeping a little piece in this position until I get a proper exit indicator. Because a lot of us, we're not selling because we see an exit indicator. We're selling because we're green and we don't want to lose the profit, which comes from a place of fear. That gets you into the habit of holding losers too long and selling winners too soon. And when you do that, you've got an inverted profit loss ratio, and statistically, you're setting yourself up for failure. So if this helps you extend your winners a little bit longer, I think that would be great. I hope you enjoy this episode. I hope you hit that thumbs up. And hey, feel free to download my micro pullback strategy PDF, pinned in the top of the comments, linked in the description. And I'll remind you as always that trading is risky, so take it slow, manage your risk. And I'll see you here for the next episode real soon.